I want you to take a second and just think about the abstract concept of the money you currently have to your name.
Right.
Whether that's, a folded up physical bill sitting in your pocket right now, or, let's be honest, much more likely a digital abstraction, like a number on a screen inside your banking app or your Apple Wallet.
Yeah, a glowing number on the screen.
Exactly. And you build your entire life, your security, your future planning around that number, you trust it. But the fundamental nature of that money, specifically what backs it, who controls the rails it moves on, and how you deploy it, is currently, well, it's fracturing into two very different, very radical directions.
It really is. It's a structural transformation that is happening quietly but aggressively. We're looking at a complete architectural rewrite of how value changes hands.
And to map out that rewrite for you today, we're pulling from a really fascinating stack of material. We have a recent dispatch from Binance News that outlines Elon Musk's architectural roadmap for turning X into this comprehensive everything app.
Right, the super app concept.
Yeah. And pairing with that, we have a highly strategic, honestly incredibly dense industry analysis from the technology consultancy ThoughtWorks. And that breaks down the under-the-radar mechanics of X-Money's new partnership with Visa and what that specific alliance means for the survival of traditional banks.
Yeah, which represents one extreme end of the spectrum. I mean, the hyper-centralization of finance.
Exactly.
But the third piece of material we are integrating today pulls us in the exact opposite direction. It's a groundbreaking academic paper from the Energy Studies Review, Volume 25. And the authors there propose a decentralized grassroots macroeconomic model where the literal energy your home saves or generates becomes the basis for a new global currency.
It's wild. We are essentially looking at a two-front war for the future of your transactions. On one hand, you have the ultimate corporate tech giant maneuvering to embed every single aspect of your financial life into a single social feed.
Yeah.
And on the flip side, you have this physical resource-backed revolution attempting to turn local communities and, frankly, your own home appliances into autonomous economic engines.
And even though a social media billionaire's payment strategy and a community-level renewable energy grid seem entirely unrelated,
They really do.
they are circling the exact same vulnerability in our current system. They are both direct responses to the friction and the limitations of traditional centralized fractional reserve banking.
So let's dive into the first half of that. The Binance dispatch makes it very clear that the ambition for X is not just, feature expansion. It is ecosystem capture. The goal is the everything app model. We're talking about messaging, social interaction, digital services, and native payments operating under a single unified login.
The obvious comparison here is WeChat in China,
Right.
which has achieved a level of indispensability that Western tech companies have envied for a decade. I mean, you don't just text on WeChat. You pay your utility bills, you order food, you hail a ride, all of it.
But the ThoughtWorks analysis introduces an important cultural caveat here, right? Because historically, the North American market has actively resisted the super app model.
Yeah, deeply resisted it.
We have this deeply ingrained habit of compartmentalizing our digital lives. We use Uber for rides, Instagram for photos, and Chase or Bank of America for our money. We like the walls between them.
We do. But ThoughtWorks also points out that the architectural moves X is making are designed to bypass that cultural resistance through sheer frictionless utility. And the linchpin of that strategy is the recently announced partnership with Visa.
Right, to support peer-to-peer payments via the X Money platform.
Exactly. And it's not just a branding exercise. X has been steadily acquiring money transfer licenses across various states, which is a massive regulatory hurdle.
Yeah, the MTLs.
Right. And they have a captive, highly engaged user base of roughly 600 million globally, with about 100 million in the U.S. alone. But the user base and the licenses are effectively useless without the plumbing.
Which is where Visa comes in. The ThoughtWorks analysts categorize this as a masterstroke of systemic integration.
It really is a masterstroke. Visa provides the established, globally recognized financial rails. Because building a payment network from scratch that can handle high-frequency, secure transactions without latency, without massive fraud vulnerabilities, that is a monumental engineering challenge.
And a regulatory nightmare.
Huge. By plugging into Visa, X skips a decade of infrastructure building. But more importantly, they bypass the trust deficit.
Oh, the psychological barrier.
Exactly. Convincing 600 million users to hand over their bank routing numbers to a social media company is a massive psychological barrier. But Visa's integration provides a halo of institutional legitimacy. People trust Visa.
So if we look at the immediate deployment of this, the first tectonic shift happens within the creator economy. Right now, the monetization loop on platforms like X is broken by third-party friction.
Yeah, the funnel drop-off.
Right, a creator builds an audience, but to extract value from that audience, they have to route them off-platform to a Patreon, a Substack, or a Venmo handle. And every time you force a user to click a link and open a new app, you suffer a massive drop-off in conversion.
It's the core inefficiency of the current creator web. By integrating native payments, X collapses that funnel completely. You consume a piece of content, you find it valuable, and you tip or subscribe to that creator natively, instantly, without ever leaving the feed.
The friction goes to zero.
Zero. And that creates a gravitational pull that is incredibly difficult for users and creators to escape. The creator gets better conversion rates, the user doesn't interrupt their scrolling experience, and X crucially retains the attention and the data.
But ThoughtWorks makes it clear that tipping creators is just the Trojan horse, right?
Absolutely.
The broader, far more disruptive strategy is replacing dedicated peer-to-peer apps entirely. If you owe a friend for dinner and you are already direct messaging them on X and you already have a balance sitting in your X Money account from a tip you received or a previous transaction, the utility of opening Venmo or Zelle just disappears.
It vanishes, especially when you factor in the incentive structures that ThoughtWorks speculates about. If X begins offering interest-bearing balances for funds stored natively within the app, or specific discounts for transacting through X Money, they aren't just facilitating payments anymore.
They're functioning as a shadow bank.
Exactly.
Yeah.
A shadow bank. And we cannot ignore the cryptocurrency dimension that the Binance source highlights.
Sure.
Given the platform's historical proximity to the crypto space, the integration of digital assets is inevitable. ThoughtWorks actually pushes this further, suggesting the highly probable launch of an X Money stablecoin.
Wow. A stablecoin natively integrated into a platform with 600 million active users that instantly rewrites the global remittance market.
Overnight.
Because if you want to send money cross-border right now, you are dealing with SWIFT fees, you're dealing with exchange rate spreads, multi-day settlement times.
It's painful.
Yeah, but a native stablecoin moving on X's internal ledger, that settles instantly, globally, for fractions of a cent.
It completely bypasses the traditional foreign exchange mechanisms, which brings us to the existential threat facing legacy financial institutions. ThoughtWorks used the phrase, the cost of complacency, and the data they use to back it up is staggering. They point to the Indian market as the ultimate cautionary tale for Western banks.
Yeah, the India statistic is probably the most alarming data point in the entire ThoughtWorks report. Currently, in India, bank-owned mobile apps account for less than 5% of instant payments.
Under 5%.
The other 95% of the market is entirely dominated by third-party digital wallets utilizing the UPI network. Legacy banks in India have basically been relegated to the background.
And that is a terrifying precedent for institutions in the US and Europe. If a bank loses the high-frequency day-to-day transactions, the coffee purchases, the splitting of cab fares, they lose the primary touchpoint with the customer.
Which is everything.
Right. This is why the industry is aggressively pushing toward an API-first approach and open banking frameworks.
Because if the banks try to maintain the walled garden approach, where your financial data and capabilities only exist within their proprietary app, they will simply be routed around. Open banking allows third-party platforms like X Money to securely call upon the bank's infrastructure.
But it's a double-edged sword for the banks. If they refuse to integrate, they become obsolete. If they do integrate, they risk becoming invisible white-label custodians.
Just a dumb pipe.
Exactly, a dumb pipe. The user interacts entirely with the X interface, while the bank simply holds the license and the capital in the background. The bank loses the behavioral data from the transaction, which is exactly what they use to build credit profiles, predict churn, and cross-sell highly profitable products like mortgages and investment portfolios.
Though the sources do highlight that certain legacy players are reading the writing on the wall, like JP Morgan is heavily investing in embedded payment capabilities, trying to offer these seamless API integrations to their commercial clients before tech companies eat their lunch. And in Europe, BBVA has been incredibly aggressive with open banking, utilizing APIs to distribute their financial products through third-party platforms far beyond their physical branch network.
And they are being forced into these defensive postures by the digital native challenger banks. Companies like Monzo and Revolut have captured massive market share, precisely because they built their architecture from day one to interact with the broader digital ecosystem. They offer the instant crypto integrations and the granular API access that legacy banks are still struggling to bolt onto their decades-old mainframe systems.
So that is the centralized vision, the consolidation of your social graph, your content consumption, and your financial plumbing into a single corporate entity. It offers unparalleled convenience, but it requires you to surrender your transaction data and place a monumental amount of trust in a single point of failure.
Single corporate point of failure.
Right. Which makes the academic paper from the Energy Studies Review such a fascinating counterweight. The authors there, Anto, Sugaritis, Mehta, and Murty, are proposing a macroeconomic architecture that is the exact philosophical opposite of the Everything app. They are suggesting a pivot away from fiat currency, away from tech monopolies, and toward a localized, physical resource-backed system built on watts and joules.
And the foundational concept they are introducing is the energy currency, or EC. And they ground this within the broader historical context of community currencies. These are alternative forms of exchange designed to stimulate local economic velocity rather than extraction.
Because the inherent design of traditional fiat currency, whether it's the dollar, the euro, the yen, is extractive. When you use fiat to buy goods at a major retailer or pay a massive utility conglomerate, that capital instantly leaves your local geographic community and pools in centralized corporate accounts.
It's drained away.
Right. But community currencies are explicitly engineered to trap value locally. You trade goods and services within a localized network, which strengthens community resilience.
But the authors aren't just proposing another localized bartering token. They are leveling a really comprehensive critique against the fractional reserve banking system as a whole. They argue that the current macroeconomic model is structurally incapable of managing the climate transition.
Because it's entirely dependent on endless compounding growth.
Exactly. In a fractional reserve system, the vast majority of money is created when commercial banks issue debt. Value enters the economy as a loan that must be repaid with interest, which means the economy must constantly expand and consumption must constantly increase, simply to service the debt that created the money in the first place.
It creates a systemic fragility. The authors argue this debt-fueled growth cycle leads to the inevitable boom and bust crashes that require massive inflationary government bailouts to stabilize.
Yeah.
But more importantly, a system predicated on short-term quarterly returns and endless consumption is fundamentally at odds with the long-term capital-intensive investments required for sustainable energy transitions.
And the Bloomberg NEF data they cite to support this is just brutal. If you look at the global bond market, which is the primary mechanism for financing large-scale infrastructure and government debt, less than 2.18% of that capital is allocated toward sustainable transition efforts.
That's incredibly low.
It gets worse. Institutional investors account for an abysmal 0.45% of total climate finance. Traditional financial markets are simply refusing to underwrite the green transition at the scale required because the long-term return on investment doesn't fit their quarterly debt service models.
Which leads to the central thesis of the EC concept. If the debt-backed fiat system is failing to finance the transition, we need a currency backed by the transition itself. The proposition is to strip away the debt and back the currency with physical, verifiable energy.
Specifically, energy generated by distributed renewable sources, like a local solar microgrid, or energy that is verifiably saved through demand management.
So let's break down the mechanics of how this actually works for you at the individual level. It revolves around the concept of the prosumer. You are no longer a passive consumer sitting at the end of a centralized transmission line. Your home is equipped with a smart meter that is constantly communicating with the local grid ecosystem.
And the minting of this currency is tied directly to your behavioral interaction with that grid during periods of supply-demand mismatch.
Give me an example of that.
Okay, so think about a peak demand event,
Mm-hmm.
say a severe heat wave, where the grid is nearing capacity and everyone is blasting their AC. Your smart home system can voluntarily power down non-essential appliances. Maybe it delays the HVAC cycle by 15 minutes or pauses the water heater. By shaving that peak load and providing immediate relief to the grid infrastructure, the system autonomously mints and deposits energy tokens into your wallet.
So you are literally being financially compensated for the physical absence of consumption.
Exactly. And it works in reverse as well. If local renewable generation is peaking, say the solar panels are overproducing on a mild sunny day and the grid is saturated, you could be incentivized with tokens to run energy-intensive appliances. You effectively act as a localized battery to soak up excess generation that would otherwise be curtailed and wasted.
That is so smart. But the crucial mechanism governing the value of these tokens is what the paper details as a token bonding curve.
Right.
Because this isn't an arbitrary price set by a central authority. Explain how the bonding curve works.
A bonding curve is a transparent, algorithmic market maker deployed on a decentralized ledger. It mathematically dictates the price and the circulating supply of the token based on real-time physical inputs.
And the inputs the authors identify are deeply grounded in physical infrastructure. The curve factors in the levelized cost of electricity, or LCOE, for that specific geographic region. It incorporates local feed-in tariffs, transmission costs, and grid saturation levels.
Right, so the price of the token dynamically adjusts based on these transparent metrics, which completely removes the opaque, closed-door interest rate manipulation of central banks. It ties the digital abstraction of money directly to the physical reality of generating a kilowatt hour.
But the authors introduce specific economic constraints to ensure the token actually functions as a medium of exchange, rather than just becoming a speculative asset. And this is where the concepts of velocity and expiry come into play.
Because if people hoard the tokens, expecting the value to go up, the localized economy just freezes.
Exactly. The velocity of money, the rate at which a single unit of currency changes hands, is critical for economic health.
Yeah.
To force velocity, the EC framework integrates demurrage, which is essentially an algorithmic expiry date.
It is a profound psychological shift. Think about it. If you know that the tokens you earned by balancing the grid on Tuesday will lose a percentage of their value or expire entirely by the end of the month, you are highly incentivized to deploy them immediately.
Right. Use it or lose it. You trade them in the local community marketplace for groceries, services, or even to offset your own baseload utility costs. It actively prevents the hoarding of capital and ensures the currency is constantly circulating, stimulating localized trade.
But what elevates this paper from just a localized thought experiment to a globally disruptive framework
Yeah.
is how they propose scaling this exact mechanism
Yeah.
to bridge the economic divide between the global north and the global south.
Yeah, let's get into that because the structural energy challenges in those two hemispheres are entirely different.
Complete opposites. In developing economies across the global south, the primary crisis is energy access. They lack the capital infrastructure to build out generation capacity in the first place.
Right.
In the developed global north, the infrastructure already exists, but the crisis is energy efficiency and managing the peak loads of a heavily electrified society.
And historically, those two challenges are completely siloed. But the authors outline a unified transnational EC platform where they interact directly. A community in the global north can optimize their grid efficiency, earning tokens through peak shaving and demand response. And because the token is standardized on a global ledger, they can instantly deploy those tokens to finance a crowdsourced solar microgrid in a developing region in the global south.
It creates a direct, frictionless pipeline for climate finance. It completely bypasses the traditional institutional investors who, as that Bloomberg NEF data showed, are basically failing to deploy capital.
They aren't doing it.
Right. So the community in the global south gains access to decentralized zero-interest financing to build their infrastructure. Once their solar capacity is operational, they begin generating their own tokens, which can be used to pay back the initial micro-investments or traded on the global platform for carbon credits or fiat off-ramps.
It is a brilliant mechanism for addressing the distributive injustice of global climate finance.
It really is.
Of course, the immediate skepticism anytime you discuss decentralized digital tokens on a global ledger is the crypto comparison.
The elephant in the room.
Right. The assumption is that this is just another iteration of Bitcoin carrying all the associated baggage of speculation and environmental damage. The authors anticipate this, and they dedicate Table 3 of the paper to a really granular teardown of exactly why EC is structurally distinct from legacy cryptocurrencies.
They dismantle the comparison across 4 key vectors. The first is regulatory alignment and illicit use. The paper acknowledges that a significant percentage of early Bitcoin volume, roughly 40% globally at certain points, was tied to illicit markets, precisely because the architecture prioritized pseudonymity and regulatory obfuscation.
It was a feature, not a bug, for those users.
Exactly. But the EC framework, conversely, utilizes distributed ledgers that are transparent by design and fully accessible to local regulatory bodies. It is engineered for civic compliance, not evasion.
The second vector is price volatility. Bitcoin's price discovery is driven almost entirely by speculative herd behavior and macroeconomic sentiment because it lacks an intrinsic physical anchor. An economy simply cannot function if the unit of account fluctuates by 20% in a weekend.
which is exactly what the token bonding curve is designed to solve. Because the EC's value is algorithmically tethered to the hard, physical, levelized cost of electricity and local tariff structures, it possesses intrinsic baseline value. The curve dampens speculative volatility, ensuring the token remains stable enough to actually price everyday goods and services.
But the most critical distinction, especially for a currency designed to facilitate the green transition, is the energy consumption of the network itself. The proof of work consensus mechanism that Bitcoin uses is an environmental catastrophe.
The authors highlight the widely cited data that the Bitcoin network consumes more annualized energy than the entire country of Venezuela.
Venezuela, just to secure the ledger.
Right. Proof of work is intentionally designed to become more computationally difficult and therefore more energy intensive over time to secure the network. It is a massive waste of physical resources to secure a digital abstraction.
But the EC architecture completely abandons proof of work. The tokens are not mined by massive server farms solving arbitrary cryptographic puzzles. They are minted automatically as digital receipts when a smart meter cryptographically verifies that a physical kilowatt hour was generated by a renewable source or saved through demand response. The computational overhead is negligible.
Negligible. And finally, they address the rigidity of legacy blockchains. A massive barrier to mainstream adoption for Bitcoin is irreversibility.
Oh, yeah, the fat finger problem.
Exactly. If a transaction is fraudulent or sent in error, there is no recourse. It's gone. The EC model proposes a platform-based governance structure where transactions, while secure, can be mediated and reversed by community consensus in cases of obvious error, making it viable for actual human commerce.
Now, the authors are highly transparent that this isn't the first attempt at an energy-backed token. Table 1 of the study is essentially a graveyard of past pilots. They analyze models like NRG Coin out of Brussels, Solar Coin, Atom Coin in Masdar City, Ergo, and Energy Coin.
And analyzing why those pilots failed is crucial to understanding the refined EC architecture. Solar Coin, for instance, attempted to incentivize global solar adoption but failed to anchor the token to intrinsic value. It effectively turned into a highly volatile digital coupon.
Not actual money.
Right. Atom Coin relied heavily on central budget subsidies rather than autonomous grid dynamics. Ergo experimented with demurrage, but the arbitrary 6-month expiry caused severe user friction. It wasn't organic.
So the unified EC model synthesizes the lessons from those fragmented failures. It implements the bonding curve to guarantee intrinsic value based on LCOE. It standardizes the demurrage to match physical grid cycles rather than arbitrary calendar dates. And it creates a unified global platform rather than siloed competing local coins.
And we don't have to rely entirely on academic modeling to prove this framework is viable. The paper points to live, real-world implementations that are currently executing these exact principles at scale.
The Soulshare project in Bangladesh is perhaps the most compelling proof of concept here. In rural areas entirely disconnected from the centralized national grid, Soulshare has deployed peer-to-peer swarm grids. Households with solar installations can dynamically sell their excess capacity directly to neighboring households using a digital token ledger.
They bypass utility monopolies entirely, creating localized, decentralized wealth generation based on physical energy exchange.
You see a similar architectural approach with Ochre Solar deploying microgrids across Cambodia, utilizing tokenized ledgers to securely finance and manage rural electrification where traditional legacy banks just refuse to underwrite loans.
Yeah, they won't touch it.
And Sun Exchange in South Africa is successfully using global crowdsourced micro-investments to fund commercial solar installations, paying those global investors back in digital assets tied directly to the real-time energy generation of those specific panels.
These are not theoretical white papers anymore. These are operational networks proving that energy-backed, tokenized ledgers can route around the failures of centralized finance and solve complex physical infrastructure problems.
So if we synthesize everything we've extracted from these sources today, from ThoughtWorks analysis of the Visa integration to the Energy Studies review breakdown of token bonding curves, we are looking at a fundamental battle for how you will define value and execute transactions by the end of this decade.
That's really the core of it.
Think about a completely mundane scenario in the year 2030. You walk into a cafe to buy your morning coffee. The sources we've analyzed map out two aggressively diverging architectures for how that payment clears.
In the centralized scenario, driven by the X and Visa architecture, the transaction is hyper-convenient but deeply extractive. You pay through a unified social interface. The friction is zero, but the cost is total data surveillance. A single corporate entity maps your financial velocity against your social graph, your direct messages, and your content consumption. And they weaponize that data to keep you locked within their ecosystem.
And the legacy bank you thought you used is just a silent, commoditized API call sitting underneath Visa's rails.
Exactly, just a license in the background.
And in the decentralized scenario mapped out by the EC framework, that same coffee purchase is an act of localized civic participation. You pay using a fractional unit of energy that you autonomously generated the day before by allowing your smart home to balance the local grid during a demand spike. The cafe owner receives an asset with intrinsic physical value, which they then deploy within the local network before it expires.
Creating a closed-loop solidarity economy entirely divorced from centralized tech monopolies or fiat debt cycles.
The underlying question is whether fiat currency, as we currently understand it, a centralized debt-backed instrument, can survive this bifurcation. The legacy financial institutions are caught in a crushing pincer movement.
They really are. They are being abstracted away at the top layer by super apps that control the user interface and the behavioral data. And they are being hollowed out at the foundational layer by decentralized, energy-backed ledgers that offer superior, physics-based alternatives for value transfer and climate finance.
It requires a profound psychological adjustment from all of us. We are transitioning from an era where money was a static ledger entry held by a custodian to an era where your capital is a dynamic, real-time expression of either your digital social attention or your physical energy footprint.
Which is a staggering shift in how we perceive our own value.
It is, which leaves you with a deeply philosophical implication to unpack based on this material. If the macroeconomic architecture shifts to the EC model, if your localized bank account balance is literally dictated by the real-time thermal efficiency of your house and your behavioral interaction with the power grid, how does that alter human psychology? If your economic survival is inextricably linked to your localized energy production and your ability to achieve peak demand, do you cease to be a consumer in the traditional passive sense? Do you fundamentally reorganize your physical existence and your daily habits to act as a highly optimized, localized power plant?
It essentially erases the boundary between economic participation and physical existence. Your behavioral choices regarding energy are no longer just environmental considerations. They are immediate, mathematically quantifiable financial transactions.
It is a radical reimagining of value. We hope this deep dive has equipped you with the framework to spot these architectural shifts as they happen and provided a new lens to evaluate the systems vying for control of your transactions. Keep questioning the infrastructure around you, and we will see you next time.